Over the last week, some companies have been hit hard, and today we want to take a look at 8 of them, giving you a quick deep dive as well as our overall analysis and whether we believe they should be a buy, hold or sell, whilst running them through our own valuation model. Now the first one is Chipotle Mexican Grill. Year to date, not that great, down around 15%. Over the last 10 years though, if you have been a shareholder, you would have massively outperformed the S&P, up 288%. Right now though, it is trading towards the 52-week low, with Wall Street indicating this company is a buy right now. If we are to take a look at their earnings over the next 4 quarters, they are expecting growth to every single one, all in 2025, and over the last 4, they have either outperformed or been in line with management estimates, giving them a 100% track record, and that gives us confidence they can hit their 129 EPS estimate for this full year, indicating that the company is now trading at a forward P of 41. Probably no surprises that it does have a D+ on the valuation in comparison to the sector that sits at 16.5. If you are adding CMG to your portfolio today, you are paying a 150% premium. However, if you look at their 5-year average, their forward valuation sits at 65, so you are actually getting a 37% discount, and something that is consistent no matter what valuation metric you look at today for CMG. It trades at a massive premium to the overall sector, but actually trading at a discount to their own 5-year figures. In terms of the growth, they get a B-. Now A- on the revenue, where it sits at 15% year on year, higher than the sector at 2.5, not far off their 5-year at 15.4, and expected over the next 12 months 13% growth, again higher than the sector at 3.2 and only marginally lower than the 5-year of 14.6. In terms of the EPS, something we like to draw your attention to, over the next 3 to 5 years, they anticipate it to grow at 20% year on year, sitting higher significantly than the sector at 10.9, but it does sit quite some way below their 5-year data at 24.4%. In terms of the profitability itself, with an A rating, gross margin 41%, sitting higher than the sector at 38, but also higher than their own 5-year of 38% too. In terms of the bottom line, 14%, well above the sector at 4, as well as above their own comparative at 9.4, telling us they do have efficiencies. Over the longer term, they have been improving on both their gross and bottom line margin, and this company does generate a significant amount of cash from operations, 2.11 billion, well above the sector at 285 million, but also significantly higher than what we have seen from this company over the last 5 years at 1.3 billion. We also just want to highlight what have the institutions themselves been doing with 91% ownership. They did sell around 4.2 billion over the last year, pretty much all of 2024, but they've been buying a significant amount more, sitting at just under 18 billion, and something we have noted as well in the most recent quarter, Q4 of 2024, institutions are incredibly bullish on Chipotle Mexican Grill. As we said, we're going to give our own viewpoint when looking at it in the valuation model. Today, CMG, we get to $70 derived from the DCF model. Now we'll show you how we got to this, the free cash flow year on year. Average growth sitting at 41%. Growth rate moving forwards, we've gone for 20. Now these numbers are subjective, as you can see, 3 different growth rates, and you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for CMG or any others, but based on 20% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and $70, as we can see, indicating 35% upside. Now for full transparency, we will show you the lower rate of 15%, $49, indicating actually downside of 6%. So if you don't believe over the long term they can grow their free cash flows above 15%, then right now the company could look to be overvalued or trading at a premium. For those that are a lot more bullish at 25%, $99, indicating 90% upside. That is nearly a double from the current value. As always though, on the channel we take through the medium rate, today 20%, where we're not just done there because we do like to add a margin of safety. 10%, execute on that if it meets our 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data, meaning if you believe that for CMG, a buy at around $63, and then we keep going till it's near the current trading price. And what we can see for Chipotle Mexican Grill, you're getting a 25% margin of safety based on the estimates for the free cash flow we just ran through, and Wall Street themselves do see this as a buying opportunity. They had a buy rating, they see this at $67 over the next year, and that translates to 29% upside As always, give us your thoughts below. Now, before we go into the next stock, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks for your attention, as well as what's going on in the market. You can click below, sign up, and read straight away, where you'll be able to gain access to 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 32 stocks that Wall Street themselves believe that have the most upside right now in the S&P. So click below, you can sign up and read straight away. We then move on to the next stock, which is Amazon, down 3% today. Year to date, also in the negative, although no surprises, over the last 10 years, up more than 1,000%, again significantly outperforming the S&P. Right now, they're still trading at the upper end of the 52-week range, although quite a pullback from their 52-week high at $243, with both Wall Street and Quant giving this a strong buy. Seeking Alpha themselves also believe this is one to consider in the overall portfolio. In terms of the earnings, green right across the board, 100% track record, growth anticipated all of 2025, and based on the EPS estimate of 631, this company now trades at a forward PE of 35.3. In terms of valuation, they do get a C-. What we have noted in terms of the sector, right now you're paying a 114% premium. In terms of their 5-year average though, right now it does sit 80% lower, and something that is pretty much consistent no matter what valuation metric. Amazon trades at a massive premium to the overall market, but actually significantly lower for the vast majority if you compare it to Amazon's own 5-year averages. In terms of growth grade, they get an A-, year-on-year revenue up 11%, over the next 12 months around that region 10 to 11, a lot higher than the sector median on both accounts at the low to mid single digit, but it does sit quite some way below their own 5-year at 20 and 17% respectively. In terms of the next 3 to 5 years, EPS expected to grow 22%, a lot higher than the sector at 10.9, but actually lower than their own historical average of 31%. And their profitability, again, no surprises, at an A+. Gross margin 49%, a lot better than the sector at 38, also better than their own 5-year of 44, and bottom line around 10%, a lot better than both the comparatives, showing that they have also been improving on those efficiencies. And cash generated from operations 116 billion, no match for the sector at 285, but also nearly double their own 5-year that sits at 63 billion. In terms of institutions, around 72% ownership, around 48 billion worth of sales in 2024, a lot more buying over the same period, but also a lot more buying, more than double just over the most recent quarter. And again, no surprises, institutions do love this company. Now our intrinsic value arrives at $230 today. As you can see, the different growth rates, low, medium, and high. We have gone on the lower end today to be more conservative at the 20% point, and this does give a margin of safety, but not at the 10% just yet. You'd have to wait for around $207. You are pretty much at this level getting a 5% MOS, which some investors won't mind. It is a premium company, it is in the Mag 7, and does have a large runway for growth, but do give us your thoughts. Wall Street themselves, with the strong buy rating, see this at 265, translating to 23% upside over the next year. We then move on to Walmart, which is down 3% today, as well as nearly 10% over the last week. Year to date, the company is up around 4%, and over the last 10 years, massive outperformance of the S&P. Right now, it is sitting at the upper end of the 52-week range, but again, a pullback from their 52-week high of $105, with Wall Street and their buy rating 4.45, not far off the 4.5, translating into a strong buy, and they pay a dividend of 0.85%. If we look at their earnings, again, green across the board, love to see that, and based on their next full accounting period, the company does trade at a forward valuation of 36.4. Valuation grade F though, as we can see, another company trading at a premium to the overall sector by 123%, but actually this company's 5-year average forward valuation does sit a lot lower, so not only a premium to the sector, but also sitting up 41% from their own 5-year, and again something reflective across all of their valuation metrics. Walmart is significantly higher than both sector and their historical data. In terms of growth, they do get a D+, yet we do notice year-on-year revenue of 5%, well above the sector at 1.6, but in line with their own 5-year at 5%. Forward looking, near 5%, again above the sector and slightly above their historical data of 3.9. In terms of the EPS over the next 3 to 5 years, same to be said, 9% above both sector as well as their historical data of 7.3. If we were to look at their profitability, well, they get an A+, gross margin 25% below the sector of 36, but pretty much in line with their historical figures. In terms of the bottom line, 3%, again below the sector at 4, but pretty much around the same as the last 5 years. In terms of cash from operations, though, significantly higher, near 37 billion, the sector at 800 million, and also marginally higher than their 5-year of 31 billion. Institutions hold around 27% ownership, and pretty much a common theme so far. Whilst institutions have been selling, they've been buying a significant amount more, and they bought twice as much just in that most recent quarter, so clear to see they are very, very bullish. Now, our intrinsic value, $97, the average of these three models, doesn't really give a margin of safety today. What this means, based on the drop we've seen over the last week, we believe Walmart is now trading around its fair value. For those that want to see, at 10% MOS, a buy at $87, at 20% around $77, and at 25% around the $72 mark. Wall Street, however, with their near strong buy rating, see this at $115 over the next 12 months, translating to 22% upside, and do let us know your thoughts below. We then move on to Fair Isaac Corporation, down 2% just today, year to date down 15%. However, over the last 10 years, massive outperformance of the S&P, up 1,885, now trading towards the lower end, or mid to lower end in fact, of the 52-week range, with a buy rating from Wall Street. When we talk about this company, they do expect double-digit EPS growth over the next 4 quarters. However, they have missed not only their most recent quarter, but 2 of the last 4, giving them a 50% track record. And based on the September 2025 earnings per share, the company does trade at quite a lofty valuation of 59.3. They're in turn giving them a D+ on valuation, no real complaints there given the sector sits at 25, meaning you are paying a 134% premium, but also their 5-year average does sit lower, around 34.5% to be exact, and something that is reinforced no matter what valuation metric you look at today. Growth, though, sitting at a B+, does look good at around 15% both year on year and forward looking, with the sector coming in at the mid-single digit, also a lot better than their 5-year average sitting around the 8 to 9%. In terms of EPS, though, moving forwards, expected to be very, very strong, 32%, a lot better than the sector at 15, but also significantly better than their own 5-year average of 17.3, and profitability, no complaints whatsoever with the A+, 80% gross margin, well above the sector at 50, also above their 5-year of 76, bottom line 31%, a lot better than the 4% of the sector, but also better than their 5-year of 26, meaning efficiencies right across the board, increases to revenue, increases to margin, and we do notice cash from operations very strong, 705 million above the 99 of the sector and 449 of their own 5-year historical data. Institutional aspect, 86% ownership, 6 billion worth of sales, pretty much the same amount of buys, so neither bearish nor bullish over the last year, but we can see in the most recent quarter for Fair Isaac Corporation, institutions were selling a little bit more. In terms of the intrinsic value today, $2,129, as we can see the different growth rates, low, medium, and high, we've gone for 25% today, which will give a margin of safety as we do keep going, 10% buy at 1916, at 20% 1703, which is pretty much where we see this company now, 20% MOS, at 25 for those that want to see around $1,600, but based on the 20% margin of safety, Wall Street see this upside of 30%. They see this company in a year's time trading at $2,200. We then move on to Lululemon, which is down nearly 3% today, also down year to date around 7%. Over the last 10 years though, massive outperformance of the S&P, up 421%, trading in the mid to lower end of the 52-week range, a strong buy from Quant and a buy from Wall Street. And when we look at their earnings, green right across the board. January 2026, this company's next full accounting period, meaning their forward P right now sitting at 23.8. How does that compare? Well, they get a D+, so no surprises, trading at a premium to the overall sector by around 55%, but their 5-year average does sit way higher at 43, meaning it trades 40% lower, and again, a very common theme noted for Lululemon in terms of the sector comparative, trading at a massive premium. In terms of the 5-year comparison with their own historical data, they're trading at a much far cheaper valuation. In terms of growth, they get a C-, year on year and forward looking in the 11% region, a lot better than the low single digit of the sector around 2 to 3%, but actually we do notice the last 5 years has shown a lot higher growth around 19 to 23%. Earnings per share over the next 3 to 5 years, not looking too great with the C+ rating, around 12%. It is above the sector 11, but over the last 5 years, a lot stronger, around 18%. In terms of profitability, sitting at an A, gross margin 59%, better than the sector at 38%, but a little bit better than their own 5-year of 57%. In terms of bottom line, 17%, a lot stronger than both comparatives at 4% and 14% respectively. Cash from operations looking very strong, 2.3 billion, well above the sector at 285 million, but also nearly double their own 5-year at 1.28 billion. Institutions, around 85% ownership, they have been selling 7.7 billion, but also buying nearly 10 billion, and also buying more over the most recent quarter, so institutions clearly very bullish on Lululemon. Now, today's episode, we get $424 as the essential intrinsic price, and that is based on a 10% rate, but you can clearly see 8% is pretty much what this company is trading at, given very minimal upside. 12% though, if you are very bullish, that's upside around 37%. So in terms of margin of safety for Lululemon, at 10%, a buy at 381, at 15 around 360, which is where we see this right now, with Wall Street 450 over the next year, upside of 26%. Then we move on to the Home Depot, down around 2% today. Year to date, pretty much flat. Over the last 10 years though, it has outperformed the S&P, up 238%. Right now trading pretty much bang in the middle of the 52-week range, a sell from CE Alpha, a buy from Wall Street, and a hold from Quant, and the company does pay a dividend around 2.3%. Another green right across the board, and their next full accounting period does give this company's forward valuation the 25.1 region. In terms of then looking at the valuation grade at a D, another company sitting well above the sector, a 58% premium, but also sitting marginally above their own 5-year average at 17%, and something we can clearly see both over the essential sector comparative, but also slightly over their own 5-year data. In terms of growth, D-, not looking good at all. Revenue pretty much flat over the last year, below both the sector at low single digit, but also below their own 5-year of 7%. Forward looking, 1.5, not great either, again below both comparatives at 3 and 5% respectively. And in terms of the earnings per share, looking very dire, only 4% growth over the next 3 to 5 years, 11% for the sector and 8% for their own historical point. In terms of profitability, at an A+, looking a lot better. Gross profit margin 33%. In terms of the sector, it does sit high at 38%, but not too far off the 5-year average of 34%. And in terms of their bottom line, near 10%, sector at 4.3%, so that does sit lower, and in terms of their 5-year, not too far off, again around the 10% region. Cash from operations, this is what really stands out, around 20 billion over the last year, significantly above the sector at 285 million, but also above their own 5-year average of 17.5 billion. In terms of institutions, 71% ownership, 18 billion worth of sales, but a lot more buying. Institutions clearly very bullish, and something that is reconfirmed in the latest quarter, where they have been buying more than they have in fact been selling. Intrinsic value, we get to $441, and when we do go by in terms of the margin of safety, we can in fact see not at the 15% level just yet, you're getting somewhere between 10 to 15, with Wall Street themselves seeing this at 445 over the next year, translating to 15% upside, and do give us your thoughts below. We then move on to Salesforce, which is down around 3% today, year to date down nearly 8%. Over the last 10 years though, massively outperforming the S&P again, up 346. Right now trading in the mid to upper end of the 52-week range, with only Wall Street calling this company a buy, and they pay a dividend, although on the lower end at 0.5%. If we look at their earnings, green over the next 4 quarters, however they did miss their most recent earnings, giving them a 75% track record, and based on the EPS of 11.21, it does trade at a forward valuation of 28.4. In terms of grading F, again, you are seeing a common theme with the stocks today. They do trade above the sector median, this one in particular at 25%, but actually over the last 5 years, they have traded a lot lower. So right now it sits 25% lower, and in terms of other comparatives, a very similar conclusion, trading well above the sector comparative. In terms of growth, it does sit at a B, year on year and over the next 12 months, around 10%, a lot better than the sector comparative in the mid-single digit, but over the last 5 years, they have grown at a much faster rate, 20 and 18% respectively. In terms of the EPS, expected over the next 3 to 5 years, 18% growth, above the sector at 15, but slightly below their own data at 20.4. Profitability A+, gross margin 77%, sector at 51, sitting a little bit higher than their 5-year average of 74, and bottom line, same to be said, 16%, well above both sector at 4 and their 5-year at 8.6. Cash from operations also significant, 12.5 billion, the sector much lower at 99 million, but so has been their 5-year at 7.25. This company continues to generate a significant amount of cash. Institutional ownership 81%, 23 billion worth of sales, but a lot more buying at 30 billion, and the same to be said over the most recent quarter. Institutions clearly very, very bullish. In terms of our price, we get to $371. Again, the different rates here, low, medium, and high, 10, 12, 14. We've gone 12% moving forwards, and what we can see, quite a substantial margin of safety in today's episode. Nearly the 20% point, around $297, so you're getting 15 to 20%, with Wall Street themselves seeing this as a good opportunity. 397 over the next year, translating to 28% upside. We then move on to Applied Materials, down nearly 3% today. Year to date, they are up around 6%. Over the last 10 years, massive outperformance of the S&P, up 586, trading right now near its 52-week low. Both Wall Street and Seeking Alpha consider this company a buy, with a current yield on offer of 0.91%. In terms of earnings, green nearly right across the board. They expect 3 of the next 4 to be growth, 75%, and based on October 2025 EPS estimate, the company does trade at a forward valuation of just under 19, and even though they get an F on the valuation, they trade lower than the sector at around 26%, but pretty much in line with their own 5-year historical average, and you can see similar results across all of the valuation metrics. Growth not looking too good at a D+, year on year and forward looking in the mid-single digit, although that is pretty much in line with the sector median, however significantly lower than their own 5-year average of 13 and 9% respectively, and over the next 3 to 5 years, they're anticipated to grow their EPS near 12%, which is significantly lower than the sector at 15, but pretty much around the levels we have seen historically from Applied Materials. In terms of profitability, A+, gross margin looking decent at 48%, a little bit lower than the sector at 50, but a little bit higher than their 5-year. Bottom line, 23%, a lot better than the sector, a little bit lower than the 5-year of 24, and cash generated from operations significantly high, 7.3 billion, well above the 98 million from the sector, but also quite some way above their own historical data of 6 billion. Institutions around 81% ownership, around 15.3 billion worth of sales, but around the same amount of buys, maybe a little bit more buying, although in the most recent quarter we see a little bit more selling. In terms of the valuation today, we get $243, which when we do apply a margin of safety, you can see maybe the most significant today at $170, not far off. You're getting a 30% MOS. Wall Street see 24% upside, 215 over the next year, but bear in mind this is a cyclical company, and that is why maybe a larger margin of safety is something that you'd want. As always, give us your thoughts though about these 8 stocks today, whether any of them for you are a buy, hold, or sell. Don't forget as always to sign up to the free weekly newsletter, new one coming to your inbox Monday morning. Grab those spreadsheets, come and join us on Patreon where we do cover our weekly buys and sells, and we have been making some movements in the portfolio given the volatility. And as always, have a great day. We'll see you all on the next one.